Hello, welcome to our podcast. Today, Friday, October 8th, now 25 past 10 p.m. And we're here in Brazil. I'm going to make our analysis of Bitcoin prices as quoted in Tether at Binance. So, why is that? Because it's the most traded pair in the most traded exchange. So we see this as a representation of the market as an overall. So it's the main indicator of the cryptocurrency market. So far it can serve like that, and soon we might need to consider Ethereum as well because of this departure between Bitcoin. The market insists in seeing it as a reserve of value, and as well as Ethereum as a platform for whatever DeFi industry and so on. So we might need to decouple them. By now, we don't see this as needed as they have the same trend. In short, we don't see Bitcoin going down while Ethereum going up or vice versa. So knowing one, you know the other. As a main point, we have in our last analysis considered that this was the top of a trading range. We're gonna give a zoom here. So we are seeing this range from 40 at the bottom and 48 at the top. Of course, it was breached and we're counting with a return to the moving average. It went exactly the opposite. Right now, it's trading around 54,000. And we still believe this is the end for it. Each time it goes up, we repeat the same. I know it's we were wrong here. We might be wrong again, but still we insist in our position because the volume has not exceeded the threshold to become extraordinary. We are still within or below the last 200 days average in volume, which is this shady area here over the volume bars. So why is that meaningful? Well, if the price is going up and that's what you want, why aren't you in? No, but I am in. Okay, you are in. What about the others? What about everyone else? So that's the point. We should be seeing a spike in volume here, in traded volume. As I said, this is the most traded pair in the most traded exchange. So why on earth it does not has higher volume since it is now going to whatever 100k, it doesn't matter. Okay, so that's our main point, main argument for it to be bearish, because it's not, the volume is not there, the price is going up and the volume is not. So we consider that a sucker's rally. This is a dead cat bounce. Regardless if we'll be wrong, we might, okay, like just to mention Stanley Druckenmiller, I'll go to my grave, often wrong, never in doubt. So that's our main point about this movement. So no volume. Second point, let's put this one is now in favor or of a moving up. We mentioned that we will put here our tool, which is not our tool, but the tool that we use in this sense, ours, Ishimoku clouds. Okay, in our interpretation, price above the cloud, you buy or not, but never sell. Price below the cloud, you never buy. So never long below the cloud, never short above the cloud. So that's the main point. Now what we're seeing here, we have this red line, which is called Kijun Sen, and we have this blue line, which is called Tenkan Sen. So basically they are an average between the max and the mean between the last 9 periods, which is the blue, Tenkan Sen, and the last 26 periods, which is the red. So it's a bit slower, the red. And kind of that you project here to form the cloud. So as an average between those two, etc. The exact formula, we don't have it in mind, but it's not far from what you just said. But as a rule that we follow, might follow different ones or better ones. Good for you. Would like that you share this with us. But our point is when the price is above the Kijun Sen, which is this red, and both special and as well as the blue Tenkan Sen are above the cloud, that means you can have an long position open. And when you open it, as soon as you have those three conditions established, so once the third one goes above, which is this Keynesian saying that is going above today, so then you can open a position because it was kind of still inside the cloud. It's going out right now. It's very much in the twilight zone here between them. So it's a matter of goodwill to say if this is above the cloud or still inside the cloud. Okay, so if it's still inside the cloud, you should wait. And if it just went out, then now you can open a long position. So that's the main point about an uptrend, and then you let it go. Okay, the problem is that you have a high trend uptrend confirmation when it is quite far, the price are quite far from the Keynesian saying. So you might need to put a stop loss that is very long, very wide, and that might make you suffer, incur in losses. Or even if you put, for example, something intermediary like a stop loss based on daily volatility, if it exceeds what's the normal, it moves, you go out, still you have some significant losses, about 8-10% in this range. So it might not be the best moment to enter. That's not our point. Just to say that in the daily chart, this Ishimoku reading is turning bullish. Bullish in the sense that you can, it's favoring a long position to be open. So that's positive for those who believe price is going up. Now, another aspect that we like to mention is, that's it for Ishimoku in our analysis. Let's go to the weekly chart and see how the week is going. So right now we just closed our Friday. We already started in UTC Saturday, so we'll have still 48 hours, a bit less, 47, to the end of the week, which is about 30% of the week. So we might likely to exceed the previous week in volume, which is a positive signal because it's so far so good. A green candle or bar here, so we're going up, the volume is increasing, but we're still within the last 200 periods, in this case the last 200 weeks volume, and we're not likely to exceed it if the projection continues, like if you end the week with the same proportional volume we had so far, we're likely not to exceed it. And so again, why not, if we're really going up? No. So maybe we need one more week, at least in this perspective, weekly perspective, to see if this is effective movement or it's ending now. At its favor is that we exceeded the previous top here on a 53, just the 53.5K. So that's positive for now. Okay, but this week still have not ended. We need to see how it goes. So basically we are in a region that's not confirmed the breach of this previous region, although our trading range before in 48K was already breached. So in our view, if this breaching was true, was not false, was legitimate, then there will have been an increase in volume, which so far we have not seen. So that's our main point. We would like to show you something else here, which is the relation between the dollar index and a Bitcoin price. So we'll remove here by now the moving average, and we're going to this type of comparison. We do that in higher time intervals because those things take time to play out. So again, we want to show you that when the dollar was very high comparatively to now, Bitcoin was very low. Then as the dollar fell, it opened room for Bitcoin to go up. It might be a coincidence. We are not saying this caused that, but it likely helped, at least in enabling it. Why? because as the dollar becomes cheaper, it stimulates moving out of dollar bounded assets to something else to preserve your purchase power. It can be other currencies, it can be hard assets, and perhaps amongst them Bitcoin. So it coincides with this sharp rise in the Bitcoin prices with the sharp fall in the dollar index, which is the dollar measured against a basket of foreign currencies. Now what we have here is the dollar rising, and it might have an effect on the Bitcoin price. Now, the point is, will the dollar keep rising or not? And that's the point that we wanted to show with you today. So for that, we will show you here a chart that we follow it and we observe its moves. So basically we have here, let us show step by step. I will remove here dollar index. This is the US 10Y monthly chart. Okay, this is what the yields of the 10-year treasury bill or note. I think it's bill, the correct term. So the 10-year yield has been decreasing, which is not news, okay, since the early 80s when Mr. Paul Volcker hiked up the interest rates to curb inflation in the United States. Since then, we have been on a deflationary period, which was followed by lowering interest rates. And here we are, nowadays, 2021. What happened is that we have a low here in 0.3, 0.4, which is extremely low. And then they started rising. This is one point. But United States, it's not isolated in the world. And we have here a Germany, which passed by a similar process, but however, it might not make sense to look then beyond 1991 when euro was established. So you can see here a sharp decrease in the interest rate and following the same phenomenon. So it's a global phenomenon. So why Germany? Because that's the biggest financial power in the second largest financial market, which is Europe. So we have United States and Europe. Okay, so here it is. So both are falling. So we can measure here the difference between those two. That's very interesting. Why? Why will one do that? Well, because it shows, in our view, the pressure on the money. So where the money tends to flow. So as this difference rises, it should push money, for example, inside the United States. And if it fall, or not necessarily push money inside the United States, like in the sense of current account balances, but it should invalue the dollar against euro, and the reverse and vice versa. So when this different falls that strengthens the euro against the dollar. So in order to check that, we can do, for example, a comparison here with the pair euro USD, okay, for example, in a new scale. Okay, so we can see here that when this, for example, falls, this different falls, the euro dollar rises, and vice versa. Okay, so kind of there are periods where they are moving along, separated, but here you have a rise in the difference, you have a fall in the euro dollar, and here you have, for example, a fall in the difference, a rise in the euro dollar. So eventually they move alongside, like here, for example, and eventually they take different directions. But currently what we are having here is you have here falling in the difference between the interest rates. You had a fall in the euro dollar, and now they are moving along together. So let's check the following difference, and that's the following ratio, and that has called us the attention enormously. Perhaps I should have started with it before, which is the following. This chart here shows the ratio of the dollar euro pair, which is the reverse, and the difference between the interest rates in the United States and in Germany bonds. So now look, if you look in the years from 2013 here, they were pretty much stable, and that's our main point. So they were pretty much stable, and if you look at they tend, let's move it out here, they tend to converge to a point which is kind of 0.54. So the exact value is not relevant, but it's interesting that it's floating around it. That means, and that's our point, that when they kind of cancel, they move alongside. So when the dollar euro rises, it tends to be in tandem with the difference between the 10-year yield in USA and in the German bonds to rise as well, and vice versa. So they both rise together or fall together. So they move in tandem. And that's our point that we like to stress here. So we look this in the weekly chart because we have higher data. And now we put the average here, for example, and we see that the average is currently in 51.51, okay? Visually here, we see something like 0.54, 0.55 in this region. So anyway, let's give it a zoom. We are currently below the average. So we see this ratio, US euro against or over the difference between the yields in USA and Germany. This ratio is currently below the average, and it tends to go up. We see it going till 0.54, but let's say at least to 0.51, which is the current nearly 52, which is currently the value of the average. Well, hi Nata, how are you? So what we see going on, we see this value rising. And what does that mean? Well, that means that either the US Germany 10-year yield difference will fall, or the USD euro pair, which will rise, which means the euro dollar pair will fall. So one of both. Okay, so what is going on is that the difference between the US 10Y and the 10Y is rising, and that means that USD euro should rise as well and beyond that. And that's something interesting, because 50% of the dollar index is the dollar measured against the euro. So if the pair dollar euro should rise further, not just to compensate the fall in the difference between, the rise in the difference between the yields in United States and Germany, it will really fall. And that makes us go to our DXY chart. And here we are in the weekly chart. So we see it breaking above this moving average, potentially to the region 95, 96. And if we look in the month chart, it makes more sense. We're already above it. So yes, we could see it rising to 95, maybe this average between the two regions here to make a third rise. Okay, we don't see it breaching above 102, but that would be enough disaster. So we see it around 95, 97. So let's go again to our Bitcoin chart and compare it with the index DXY to see what could happen with the price was the DXY to keep rising. So here we are in the left side scale, we are 94. If we go to 95, 96, we can have, we should have a rise, a sharp fall in the price of Bitcoin, okay? And that, if we're going to have equivalence, would take us to the region of 10K. So even if that does not materialize, we see this rise in here being what will determine our curve here to make 180 and start falling. Now, when this is gonna happen? Well, we don't see room, seeing just in this chart, where the prices keep rising to the top here, which is 64K. We don't see this happening because the dollar index is already too high for that. Note that when this was happening here, we were with the dollar index around 93 and below to the 89 region. And until we visit that, we don't believe we'll be able to visit the all-time high here. So that's a different analysis. And the point that you're making is if the dollar index keeps rising or does not fall, there's not room for the prices of Bitcoin keep rising, assuming that this is the relation that's governing these prices. So compared to the lack of volume that we can see here in the chart, even in the monthly one, the volume is falling. Compared to the weekly chart where we have a similar behavior in falling volume, as we have rising prices, and the current week is an exception. And here in the daily chart, we have precisely that. The prices are rising, but the volume are all below, except one day here, which was a few days ago, 3 days ago. We are not having volumes beyond the average, above the average of the last 200 days, which is a bad signal with the absence of strength. And thus, we still believe that although we are above the previous most recent peak, and we have established then higher highs, we are likely to see a U-turn in prices. So that's our point. Although we were wrong before, we might be wrong now, but our main point remains. If prices are going up, why isn't everybody buying? So we'd like that you consider this in your purchase decisions. And if you're going to enter the market, we are not giving any advice, but we suggest that you consider stop loss or a hedge protection, because you might be wrong. Thank you very much.